In early June, SpaceX completed a massive $86 billion initial public offering, establishing its position as the most highly valued aerospace entity. Immediately after that massive equity raise, the company pivoted to the debt market. They issued a $25 billion corporate bond, and the initial response looked like another complete victory. Institutional orders flooded in, swelling the book to $90 billion, backed by highly coveted investment-grade ratings from Moody's and Fitch. But within exactly 48 hours of pricing, that momentum collapsed. The secondary market turned on the bonds, triggering a severe and rapid sell-off. To see the precise damage, we look at the longest-dated notes. This CNBC report confirms that the bonds maturing in 2056 saw their credit spreads widen drastically, racking up $305 million in paper losses against U.S. Treasuries almost instantly. This raises a critical question for the capital markets. Why did a company with an impenetrable tech halo, armed with an official investment-grade rating, face a ruthless, immediate rejection by fixed-income traders? The answer starts with the anatomy of that initial $90 billion order book. That massive figure projected intense demand, but it was largely an illusion. A significant portion of those orders came from fast money arbitrars. These are highly speculative accounts looking to flip the bonds for a quick fractional profit in the secondary market, rather than traditional long-term institutional buyers looking to hold the debt for decades. When the actual long-term buyers hesitated to step in at the underwriters' aggressive pricing, the fast money accounts realized there was no safety net. They panicked and rushed for the exit simultaneously, triggering a liquidation event that crushed the bond prices. The volume of early orders in modern, high-profile tech offerings can easily mask deep, underlying hesitation among the serious money managers. To understand why those serious money managers hesitated, we have to look at why SpaceX needed $25 billion right now. The company was facing a hard deadline to clear a $20 billion bridge loan, a short-term loan used directly to absorb the legacy debt of Elon Musk's artificial intelligence venture, xAI. This split-screen visualization illustrates Wall Street's divide. Equity investors focus on this upward curve, Starlink scaling to 12 million active subscribers, alongside an absolute monopoly over global orbital launches. But bondholders look at the consolidated balance sheet. The xAI integration represents a staggering $6.4 billion operating loss, forcing aerospace profits to carry a cash-burning AI startup. Beyond the raw numbers, credit rating agencies like Fitch and Moody's issued specific warnings regarding corporate governance. They flagged the extreme concentration of voting power and operational reliance on a single individual, viewing it as a severe structural risk for multi-decade loans. Ultimately, equity investors gladly price in the dream of a multi-platform computing and space monopoly. Debt investors, however, are pricing in the nightmare of a massive, unproven cash liability. Standard & Poor's made this liability explicit. Their credit assessment projected that the intense capital requirements for AI and Starship development will keep SpaceX operating with negative free cash flow all the way through 2029. This highlights the core psychology of corporate lending. Bondholders require actual, predictable cash flows to guarantee repayment. They assign zero value to speculative future AI revenue expectations until those revenues actually materialize in the bank. That lack of immediate cash flow becomes acutely dangerous when you look at the company's trajectory, with total projected borrowings expected to balloon to $132 billion by 2028. As the chief investment officer at Allianz bluntly noted, equity investors might accompany you to Mars, but bond investors will only ask, "Where is my coupon payment?" The sudden repricing of SpaceX's debt is not an isolated incident. It serves as patient zero for a much larger systemic risk building across the technology sector. This chart tracks hyperscaler capital expenditures. To build AI infrastructure, these giants will spend $770 billion by 2026. To fund this, an overlay shows AI-related corporate debt issuance has exploded 357% year-over-year. The 48-hour liquidation of SpaceX bonds proves credit markets are finally drawing a hard line. Lenders are refusing to indefinitely finance capital-intensive AI projects that lack proven, immediate cash generation. As patience for cash-burning AI promises runs out, the entire technology bond sector is staring down a structural repricing. A celebrated tech halo and a charismatic founder are incredibly powerful tools for securing record-breaking IPOs, but they are mathematically useless against the rigorous, cold pricing models of the fixed income market. While innovation premiums dictate the sky-high valuations of the equity markets, financial gravity firmly governs the debt markets. No matter how disruptive the technology or how grand the vision for the future, capital preservation and the actual mathematical ability to repay a loan remain the ultimate yardsticks of corporate survival. The analysis provided in this video is for informational and academic purposes only and does not constitute investment advice. Always consult a licensed professional before making financial decisions.